Perhaps no business is more important to their industry's supply chain than this one. Now, this has been true for many years. However, its importance has become more amplified in recent years. This is due to the explosive growth of AI, which relies heavily on high-performing and cutting-edge chips. Even more interesting is that the equipment required to manufacture these chips can only be made by this business, a literal monopoly on this advanced tech, and this monopoly will last for decades. I'm talking about ASML, and they just released their earnings. Welcome to The Quality Investor. ASML is arguably the most important company in the world. It is the only business capable of developing the EUV lithography equipment necessary to produce the chips that run our modern world. Without them, the semiconductor industry simply could not scale to meet the demands of modern electronics. This means that their economic moat is wider than oceans and just as deep. Further, demand for AI is only increasing, which increases demand for data centers, which increases demand for the chips that drive them, which increases demand for the equipment, the only equipment that can produce them. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. These machines cost upwards of $220 million each and require significant infrastructure and maintenance. The price has increased from about $145 million in 2022, representing a 51% increase in that time. That is true pricing power, and ASML is certainly leveraging it. Net bookings, a key metric for ASML, came in at 5.4 billion euros, which exceeded estimates of about 5.2 billion euros. This contributed to the positive sentiment for the stock post-earnings, about a rise of 2.7% on the day of the release. ASML performed well on the bottom line, also beating estimates with a strong €5.48 earnings per share number, while revenue grew slightly year over year at about 3.5%. We did see gross margin expansion also of about 80 bips to 51.6%. However, 2025 has been a year that hasn't seen a strong ramp up of growth, and in fact, the 2026 guidance was cautious due to an anticipated decline in China sales because of U.S. export restrictions. Looking into the medium term for ASML, growth should continue to accelerate, getting back to 10+%. Demand will stabilize as businesses adjust to trade restrictions, but even more will start accelerating as AI continues to scale. ASML has strong pricing power with EUV machines, which continue to push their margins higher. And since these machines require complex servicing, ASML will also expand their margins from the higher margin recurring service and upgrade revenue. Therefore, ASML is well positioned to profit from the burgeoning AI age. This is part of the reason ASML has performed so well in 2025, up 48.5%. The market is clearly recognizing ASML's necessity in the future of modern technology despite a lackluster 2025. So today, I want to go over their earnings and discuss a good entry point into this stock as a quality investor. So, without further ado, let's get into it. ASML went into the weekend at $1,029.27. A very strong showing so far in 2025. You can see on that 5-day chart after their earnings, they had a nice little pop, and they have been rising steadily ever since. Like I said at the outset, ASML is integral to the semiconductor supply chain. They make a machine that literally cannot be replicated by any other business at this point. And with the United States cracking down on what sort of tech China can gain from really the West in general, it's even going to be very difficult for China to take this tech and replicate it on their own, which China tends to do with Western technology. On top of that, it just takes such a massive amount of capital investment to ramp up to the expertise that ASML has, This business is just going to be a solid monopoly, compounding free cash flow, compounding returns for investors over the next few decades with really no competition in sight. And I must say, early in the year, especially around April, the whole tariff debacle, they went down into the high 500s. And I regret not buying them then. I looked at them at that point. I should have bought it. I held off. And it was definitely a missed opportunity as they've done wonderfully since that point. However, I'm not going to dwell on that. Let's look at their earnings real quick, and then we'll assess what their entry point should be. So at a high level, we see the Q3 total net sales here, $7.5 billion. They had a very strong gross margin. Like I said, it expanded about 80 bips to 51.6%. And their net bookings for the quarter were at 5.4 billion euro, which I mentioned beat what Wall Street was estimating. So there's some positive sentiment here around ASML because of this earnings report. On top of the beat, they reaffirmed their full year 2025 guidance here of a net sales increase of about 15%. So despite a little bit of caution here, and you can see that with ASML does not expect 2026 total net sales to be below 2025. Essentially, they expect sales to be about flat to slightly up. So given that caution, Wall Street is clearly pricing in medium-term expectations for ASML. And this is due to the demand for AI and really the necessity of these EUV machines to developing the chips that AI needs to power itself. I mean, the EUV net bookings were about 66% of the total net bookings. So clearly that's the direction that ASML is going. Looking at their income statement, we see that 7.5 billion euro in net sales. Like I said, a 3% increase year over year. Now, if we look at the full year to date number, they have 22.9 billion euros in net sales, up from 19 billion year to date in the prior year. That's just over a 20% increase. That actually tells you that management is expecting a decline in Q4 sales from prior year. I believe the low point of their Q4 guidance was at 9.2 billion euros. And if they hit that midpoint of at 9.5 billion euros, that would actually be a decline from 9.7 billion euros in Q4 of 2024. So we see that this whole supply chain market is tightening up a little bit, and they expect that to further continue into 2026. And really, this is all around US policy when it comes to this sensitive technology. The United States does not want it falling into Chinese hands. We are certainly in a trade war with China. And even though ASML is headquartered in the EU is pretty much going to do whatever the United States wants them to do. There's nothing that spectacular about this earnings report. Income from operations here at 2.5 billion euro, up from 2.4 billion euro a year ago. Earnings per share, 5 euro and 48 euro cents, up from 5 euro and 28 euro cents a year ago. If there wasn't such expectations around this business in the medium term because of the AI demand and the necessity of the EUV machine to create the chips required for AI, this business would probably be falling. It would still be a great buy, don't mind you, because of the fact that they're the only business in the world that can create this technology. But there is such expectation with AI that ASML is currently benefiting from that in the markets right now. And even if we don't hit that AI demand that does not come to fruition, ASML is still in a great position because, like I said, they're the only business that can create this advanced tech required to create the most advanced chips in the world. So what are these expectations, and what would be a good entry price into this quality business? My 10-year projections for ASML are as follows here. On a bear case, I have their revenue growing at about 9.6% per year, up to 15% on the bull case. The trailing 12 revenue growth is still very strong, 28.2%. And if they hit their 1 year 15% guidance here, they would have about $34 billion in revenue. Operating income on the bear case, I have at 33%, up to 40% on the bull case. The bull case assumes that they're just going to continue to skew more towards the EUV lithography sales, as well as upping that recurring servicing revenue and upgrade revenue for those. And coming down to the free cash flow margin, I have it on a bear case at 27.8%, up to 38% on the bull case. They're going to have a low free cash flow number this year. They had some negative free cash flow in Q1. However, they have a strong Q4, which they typically have their best free cash flow of the year in Q4. They can end up around $3 billion in free cash flow for the year. That would be a massive decline, about 68.9%. But I do have strong free cash flow growth going forward, so about 7.7% on the bear case up to 16.7% on the bear case. So with a share price right now, $1,029.27, that gives us a PE ratio of 37.5, which is pretty high for ASML at this point. Again, there's a lot of expectations around this business, and their forward PE sits at 40.4. We can probably expect their earnings to fall in 2026 due to the trade restrictions around the semiconductor industry, but both their PE ratio and their forward PE are expensive relative to ASML's history, but they could be cheap relative to what the future might hold. If we did a reverse DCF based on the current share price, the market is expecting about 11.6% free cash flow growth over the next 10 years. Like I said, I'm expecting about 12.2% on my base case. On the bear case, we have a DCF of $671.55 up to a bull price of $1,403.14. The dividend discount model for the bear case is at $728.72 with a bull dividend discount model price of $1,276.73. Their 10-year dividend growth, historically, by the way, is at 24.3%. My dividend growth rate for my bear case is at 12% up to 15% for the bull case. They have a very low free cash flow payout ratio. It's under 30% currently. So I continue to expect strong dividend growth from ASML. The exit multiple is currently sitting at $934.02. I'm using comps of Lam Research, KLA, and Applied Materials. So the big run-up that we've seen in ASML over the last couple of months here has certainly made their valuation average not so attractive at this point. On the bear and base case, they both have some downside. If they execute perfectly and the demand comes to fruition, we have some significant upside here of 21.86%. Without any margin of safety, I have a buy price of $979.34. With a 10% margin of safety, and I believe a 10% margin of safety is suitable for a business like ASML, simply because there are no other competitors that can really do what they do. We have a buy price of $881.40 and a forward PE of 34.6. So we would need to see some slight declines in their share price at this point to make it attractive again. Like I said, I missed it when it was in the high 500s. I would love the price to get back down again under 880. And at that point, I would certainly buy into it. This is a strong business with strong growth projections, no matter how you slice it, just due to the fact that they are the only ones that can make what they make. But again, I think it's a little rich at this point. However, there is a lot of sensitivity for this business in the market. If they have one slight miss on their earnings or one quarter that's just not up to expectations, they're going to come back down. So I'm not worried about buying back in once the price becomes reasonable again. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.